Real quick question from Kumar. I can't answer these questions very well, and I apologize for that, Kumar. I'm not a advisor of any nature. I know that's not really what you're asking in this case, but Kumar says, what do you think of current Apple price and put option? I don't know if you're talking about a married put, Kumar. Looking at Apple earlier today, it's got across the board, it's got a fairly reasonable volatility. They're fairly well priced. Implied volatility, I mean, is not too high. The deep in the money ones are, but let's go just 21 days out. Okay, so you know 0.3, that's about the norm. Here, about the same implied volatility. I'm sorry, 0.31, 0.3166. In that case, Kumar. So nothing stands to me out of the ordinary. Let's go 147 days out, and it's about the same. It's lower. Might be a decent time for a calendar in this case, but again, just go ahead and go to the stock research there. Yeah, 428. So before making any trade of any kind on Apple, just remember, Kumar, where the earnings are in this case, as we've shown a lot today, because we know we're in the earnings season. Maybe you want to wait till after earnings, even before considering opening a married put. If you're considering buying puts or buying calls, I probably wouldn't consider that unless you're trying to do a strangle or something along those lines. But the volatilities in norms, the near term, as we saw, the May are a little bit higher than the Septembers and some further out, and that's probably because we have earnings coming out in 5 days on Apple as well. Okay, Kumar did reach out. He said, I had purchased a May 21 Apple call options about 3 weeks ago, and as the option value started decreasing, I exited the trade for no loss. After 2 weeks, that is when the stock took off, and today the option is worth more than $12 when my cost was $4.60. This happens too many times. Get into good trades and exit just before they become profitable. How can I avoid this? The first thing, Kumar, I'd say honestly, talking about management again, relation to a long call position. Don't set your stops too tight. You've got to be willing to accept, most investors I talk to, you've got to be willing to accept the potential of a 35, 45, 50% loss on your calls before closing it. Because otherwise you're closing too soon and you're missing upside profit. That's perhaps the best suggestion I can give you as far as your closing goes. You see, though, Apple, you know, it fell down and then it started to recover. I know you're running out of time, and then it started to move back up as it can. So I'm not going to say you did the wrong thing at all. You know, it's better to close and not take a loss, especially if it thinks it's going negative against you. Now, this one was declining here, and I can see that I probably would have closed, as this started to do this, I would have closed in this range too, because I'm seeing a negative MACD below the 20-day moving average, hitting the lower Bollinger Band. I would never open a call in this case. And it started to flux, but then it went down further. Now when I see this, and it starts to go above the 20-day moving average, that's when I would probably look to buy. Ernie waits for, it didn't quite happen. Ernie waits for this. He looks for the Bollinger Band breakouts. Typically, we see one of those breakouts. You have a little lull, and then it continues to move up. That's what he looks for in our long call search. You said you closed it when it was decaying, and you closed it essentially for no loss. Most long call investors I talk to, and Ernie's approach of, well, you're going to have to accept that you can't just do a 10% loss on a long call. You can't set your stops too soon because you lose that just in the bid-ask spread. Yes, if you see the trends change, you want to get out of the position. And when you see them reverse, you can get back into it. Like I said, here would have been a good buy point for me. This would have been a good buy point for Ernie. Moved up, now it's coming back down. Earnings, as we saw, are coming out when they are as well. So Kumar, that's the best thing I can say to you is that accept the fact that your stop should be a loss at maybe 35, 45%. Yes, when you're running out of time, I know you only had 20, 30 days to go and you were losing time value on it. But sometimes it's just better to wait and see if it goes in your direction in that case. Okay, so that's on the management of long calls. And speaking of long call, oh, no, this is different. Stephen put his address in there, a different Stephen with a V, not Stephen S. and not Stephen from previous before, says, where can you get the 10 highest premium call options? You just got to create your own search. It's very simple. We don't do things such as highest premium because that's not really a good way to trade. Honestly, Stephen, I'm sorry. Highest covered call trade, highest naked call trade. The highest premium is not always the best trade, okay? So what do we want to do? Let's assume you're talking about covered calls here. And what we're going to do, Stephen, is just say, okay, I want to see the highest premium calls that have to match my other criteria. So I'm going to clear out the filters, keep it simple, and just go out to May, standard expiration. I'm going to want a good return if assigned of, let's say, 6%. And I want a good downside protection of at least 6% too. And I'm just going to go sort of at the money. I'm not going to go more than one strike out of the money or more than one strike in the money. So that's usually where the highest time value is. And if you're selling covered calls, the time value is the true profit on the position. Make sure you put in some good volume and some good open interest. You don't want anything that's out there with too wide of a bid-ask spread. Speaking of that, simply limit the bid-ask spread. We're going to limit the percentage to be less than 50. Okay, what else do I want? Well, if I'm doing a covered call, I probably want a stock that has a good volume. This is measured in thousands, so I'm going to only look for stocks that have an average volume of 750,000 shares per day. I'm going to look for stock prices trading in an uptrend. Just above the 50-day moving average here. I'm not going to use MACD on this one. And I also want something that's showing good management. Positive earnings per share growth, Stephen. Maybe a decent PE. I'm going to look just mid to large cap stocks in this case. And then you probably have a stock price range here if you're doing covered calls. Maybe you're not going more than $250. And as I mentioned twice before, check the box for earnings date, not between now and expiration. Then we're just going to sort it by option bid price, highest to lowest. No, there's too many with earnings between now and expiration. Let's see if that's the issue between now and May expiration. There you go. That's part of the reason. So the top highest ones that match that highest option premiums here, naturally square 246, 245 calls at 1560. Okay, so aren't there dozens of stocks in the 400 range with higher premium? Of course. Aren't there more volatile stocks around the $80 range that might have more than a $10 premium over DQ? Maybe. If they're there, they'll find them. Yeti, you expect to see there. There's one of them, 560. Okay, these are all positions that have reasonable high implied volatility. Aren't there higher ones? Yes. But if I'm doing a covered call, those higher ones don't have the other criteria that I want. In that case, it would probably result in large losses before getting any gains. So, okay, moving on now. That's just my my thought there, okay, of looking easiest way to find the highest premium in that case. Just use the search. You could use a naked put search as well, following the same rules. But remember, make sure you put in some of the basic criteria that you want. Don't just look for the highest premium, because that doesn't mean the best trade ever. It means the highest premium. Likelihood of you getting profit consistently with that and no other criteria on a consistent basis is very low.